Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no hype financial channel that is mission focused on finding you exceptional companies and unrivaled investments. Today, I'm very excited to talk to you about FuboTV. Ticker is FUBO, not to be mistaken for FUBAR, which means something very different. So the stock is up about 200% in the last couple of months. They're posting red hot revenue growth. So this is FUBO Stock that we're looking at. The company is FuboTV. FUBO is the ticker. That's for FUBO Stock. And they're posting 75% revenue growth guidance for 2021. They're looking at 70% growth this year. And this video goes out to Manish and Mo, who are both Unrivaled Investing Journey subscribers. So quick, a 10-second plug. If you enjoy learning about potential multi-baggers, make sure you hit subscribe to this channel. If you're already a subscriber, I appreciate the thumbs up. And if you want to follow my personal investment journey to try to find potential multi-baggers as well as my personal investment journey, go to unrivaledinvesting.com, click on Journey. Now let's dive into FuboTV Stock. So what is Fubo? It is I keep wanting to say FUBAR, but Fubo. Fubo! It's a sports-first streaming platform, and Fubo was founded in 2015 for live streaming for U.S. soccer fans that were unable to watch international soccer leagues. So they wanted to watch their favorite game. They weren't able to. Let's make this easier. Let's make a streaming platform, a streaming app that you can go to and you can watch international soccer coverage. You can watch whatever sports you want. This is a sports first streaming platform. And they quickly realized that users wanted a sports first cable TV replacement that could also, satisfy the needs of the entire family. And so come for the sports, which is with better coverage of live events than many other TV providers, a lot of other TV packages. Their examples are comprehensive soccer coverage, 50,000 live sporting events, NFL, NBA, NHL. So you come for the sports, and it's a really built for sports fans, and we'll get more into that in a second. And you stay for the family network, and that's sort of a message they keep talking about, saying while live sports while live sports are key to customer acquisition, we believe our broader entertainment and live news offerings continue to drive engagement and retention on the platform. This is a really key point because by focusing on sports first, it sort of gives them more leverage when they're acquiring these other channels, because they're like, look, you're not as important to me, like TNT or CNN or what have you. Like, look, you're nice to have, not need to have. Our customers come for sports. So that will be an important conversation to have when you're establishing yourself as a TV streaming player versus any other platform where they're thinking, like I got to make sure I got Fox, I got to make sure I got my CNN. They're like, well, wait a second, we are focused on sports. You're secondary. Like making the family happy, that's about retention, and there's a lot of different ways to entertain the family. As of 6/30/2020, no other live TV streaming platform had more news channels in its base plan, though. So they focus on sports, but they're like, look, we'll get you covered. We'll get you covered with our base plan. And you could see how much these things cost with a range of, let's say, $65 to $85 a month, or $80 a month, which is much more affordable than the average cable bill, which is like 110 plus, maybe closer to $200. It's at least $110 that people are paying for TV. And so it's much more affordable with a sports focus while also covering the basic necessities that most families need. So when you see this price differential, like where it's about half of the base package that you're seeing with other cable companies, you need to start asking yourself, like, well, wait a second, like, is this sustainable for them to be at this price point? Like, this seems really low. But as an investor, it makes me start thinking, if this is sustainable, do you have an unrivaled value proposition? Because clearly you are much cheaper than what the regular consumers are seeing out there, where they're you're looking at your basic like let's say DirecTV bill, and it's way more than this. Let's keep going. So this is where I wanted to follow back on how they had a sports focus. This was built from sports ground up. Like, how do we make sure the sports experience is seamless for the users, that it's really intuitive, and how do we make sure it addresses sports, fans' needs. And for example, a lot of fans like want to watch 4 different games at the same time, and they are the only streaming service where customers can watch 4 live streams simultaneously. So that's kind of interesting. And then another aspect is they wanted to make sure their DVR, their cloud DVR, which is something like an added benefit you need to pay for, is that they need to make sure it's actually really high quality, where it's at 60 frames per second, so that way you don't have any blurring on fast-paced scenes that you want to go back to. Like, oh my god, did you see that play? And it's all blurry. You want to see something that looks really crystal clear. And it seems like by starting up and trying to solve this core problem of like, how do sports fans get to watch their favorite team, whether or not it's college or NHL or NFL, how do they easily watch live streaming on an app? Like, how do we solve this problem? And the reality is, by focusing exclusively on that and then building out the family aspect later, they've created an app that users seem to love. With, if you go to different app stores, you're talking about 4.5 and up. Here it is, the Apple App Store, a 4.6 star review. And if I go through them, I'm not going to go through them here, but if you wanted to, you'd see broadly that it's a lot of 5 stars, a lot of 4 stars, mostly 5 stars. You do get the occasional 1 stars, but it's like people complaining about stupid stuff like, man, I can't believe this team, wasn't available. I couldn't watch them. And it's like, yeah, you couldn't watch them because of the pandemic. It wasn't their fault. Like, and they acknowledge, they're like, yeah, it's not FuboTV's fault, but it still sucks that I paid for this and the sports weren't on. It's like, okay, that's a challenge. What else? So how does this translate to the financials? Like, boom, let me see if I can up my game. Bam! So looking at their financials, you can see paid subscribers are up about 58% from 288,000 in the third quarter of 2019 to 455,000. So this is rapidly growing, rapidly taking market share. You can see they're raising prices for their average user, and their average user spending more. And so that's 14% increase in prices. Now this is a key point to think about, is their adjusted contribution margin is going from negative, i.e. they are charging less than it costs them, like, i.e. let's say this $60 package isn't covering the cost of all their content, and now they're just starting to, on the new customers that they're getting, they're just starting to get profitability. So i.e. if you are a new customer, you're actually, they're charging you more than what their content costs. But historically, to get this customer base of 300,000 users, they needed to sell their content effectively at below cost, which obviously isn't sustainable. So how does this translate into their financials? We continue to be focused on driving both top line growth and making progress on our path to profitability. I don't expect to see profitability in any of the near-term quarters. I think they're putting their foot onto the pedal to the metal in terms of growth. Furthermore, we believe FuboTV's differentiation in the marketplace, sports-focused programming, and a tech-focused user experience firmly positions the company for strong growth. In recent months, sports have returned despite the ongoing pandemic. The NFL has continued to play, in college football, including the Pac-12 and Big Ten, as well as soccer, have begun their return. Sports fans also enjoyed the 2020 World Series, played on schedule in October. These events have driven increased subscriber growth, viewership, and ad revenue. Remember ad revenue, we're going to talk about that in a second. So they're posting incredible growth. They're upping their fourth quarter guidance, saying, look, we're looking at 58 to 62% growth year over year in paid subs. You're looking at 500, nearly 500,000 subs. Seeing this subscriber growth means that they are taking market share, because at the end of the day, the paid TV market's not growing at 60% a year. You're talking about a market that's pretty saturated, especially as cord cutters, are looking for viable solutions. So this means they are taking share from the cords, and they're looking at revenue growth. They're looking at revenue of around $250 million, which is 65% growth year over year, and they're expecting 2021 guidance of 70% growth year over year. We're going to get into how does this translate into their financials in a minute, but they talk about some interesting things about how we're excited for the growth and revenue opportunities around online sports wagering. Ooh, we'll talk about that in a second. So let's look at their financials for the third quarter 2020. So this is the challenge. You're looking at their legacy financials, where it includes a lot of subscribers that were charged based on paying, less than what their content was actually cost them. And so that's why their subscription revenue is 53 million, but their subscriber related expenses was 61 million. That's obviously not sustainable to have revenue be less than your effectively your content cost, including your broadcasting and transmission expenses. If you need to have positive gross profit, and they're currently negative. But that's part of their, land and expand strategy of let's just grab, or that's part of their, land grab strategy of let's just grab as many customers as we can right now. But this is also reflects why they needed to raise money, and which they did in October, because, just based on third quarter results, they are at 50 million cash burn at least, and let's say 200 million annualized cash burn at least. Don't pay attention to this figure because it includes impairment of intangible assets. That's a non-cash charge. But overall, you're looking at a company that's burning hundreds of millions of dollars in cash a year based on this let's just grab as many customers as we can as possible, because it's going to take time for their new customers to result in a positive gross margin where their subscription revenue offsets their subscriber related costs. But this gets to a really interesting point of hey, what if they're selling their subscription revenue at cost, and then they start driving, you sell your subscriptions at cost to drive as many subscribers as you can, get to millions of subscribers. That gets you ad revenue, and then maybe the sports wagering, which could be very profitable, very high margin. So it's starting to sound like an interesting strategy that really would defeat many of the incumbents that are focused on making money all across the company. Now, to understand, because this company is sort of transformative in terms of their own transformation, where FuBo was actually, previously the stock was Fast Bank Group. It was a previous ticker, and then it acquired FuboTV in April 2020 in a merger transaction through which FuboTV, renamed FuboTV Media, became a wholly owned subsidiary of FaceBank Group. FaceBank Group. I mean, seriously, who names a company FaceBank Group when Facebook's out there? So prior to the merger, FaceBank Group was a character-based virtual entertainment company and a leading developer of digital human likeness for celebrities and consumers, focused on applications in traditional entertainment, sports entertainment, live events, social networking, mixed reality, for example, augmented reality and virtual reality. And what they've done is they're partnering with various different athletes or performers and saying, hey, let's get your likeness and let's use that in something cool. So they've signed up Mayweather, a professional boxer, and saying, hey, we could do a virtual battle that would look, identical to Mayweather, and put him against maybe Mike Tyson or Muhammad Ali or something like that by using their virtual likeness. But to take a step back, this is effectively a reverse merger, whereas previously FaceBank Group, which was the company, and it's a reverse merger like a SPAC, where you have this hold company and then they acquire a core asset. In this case, the core asset is FuBo, and that's why they renamed the stock FuBo, F-U-B-O. And then they raised nearly $200 million, $197 million in October 2020, transforming the company. So if you're looking at the balance sheet or the shares outstanding, it's not yet reflective if you're looking at the third quarter results, because you need to look at October 2020, which was transformative for the company. So what's the opportunity for FuBo? They're just tapping into several huge trends where they think the global, because look, they're looking to go global. They want to be a global sports streaming app. Think about Netflix is for movies and sort of big budget, exciting stuff. They're looking to be news and sports, primarily sports, and they're saying, look, 226 billion for the global pay TV market. They're saying the U.S. digital ad spend was around 130 billion, expected to grow a couple percent. But here's a key line: over the top, so that means like streaming services, advertising spend is expected to reach 5 billion in 2020. Today, streaming accounts for 18% of total TV hours viewed, but only attracts 5% of ad spend. So you should expect more and more ad spend to go through streaming platforms, just like what they have with FuBo. So I would expect their ad revenue to grow. They're tapping into huge markets, $5 billion market, global pay TV market of 226 billion. And then to top it off, as if this wasn't enough to get 10x potential. So this is definitely like, A, you may have an unrivaled value proposition. B, you're tapping into definitely 10x potential, where they're talking about they're also looking to get into global sports betting market is expected to reach approximately 155 billion by 2024. Just think about how weird or interesting or neat it could be to watch your program, then see an advertisement pop up and be like, yes, do you want to bet on this, the likelihood of a game going through? Like, do you think this team's going to win? And you can do it. And they just acquired Balto Sports as their first steps into online sports wagering market. The terms of the deal weren't disclosed, but they are actively interested in getting into online sports wagering. They talk about Balto's contest automation software to launch a free-to-play gaming offering. It sounds like it sounds sort of gimmicky. I haven't played it or tested it out, but it's it seems like they're just trying to get their foot in the door in terms of online sports wagering, which seems super interesting. I mean, look, if you're tapping into a market that's $155 billion, you might have an advantage over other sports betting sites because it's easier for you to acquire customers because you're watching TV and then boom, something pops up and you're watching TV on your iPad, so it's easy to press that button. And so they say FuboTV sees the online wagering space as complementary to our sports first live TV streaming platform. We believe there are significant synergies between consumers who enjoy wagering and our subscribers who enjoy streaming live sports, creating a flywheel opportunity. Ultimately you need to have bidders and sellers to make a real marketplace for bidding, but I could see this being a really interesting growth initiative for them. So let's keep going. So what about the valuation? And let's bring it back to me. Boom. Valuation. So when I look at the valuation, first of all, whatever you see on Yahoo Finance, that market cap information is wrong. This is why you got to read the financials. You got to double check stuff. So their shares outstanding you need to include their preferred stock, which is convertible into publicly traded shares. So all in, I'm penciling out around 140 million shares outstanding, and a $27 share price. Currently, it's run up a lot from like $10 just a couple of months ago. So you're talking about a company that's just shy of $4 billion valuation for a company that's massively losing money, $200 million loss. And they're guiding to 245 million, in revenue. So this is a pretty hefty multiple. You're talking, pretty sizable multiple to where this is. But they are expected to grow pretty quickly. Growing, they're saying, 70% plus next year. I'm putting a range on that, saying 60 to 80%, just because they did beat their guidance. But they are, unexpected things can happen, but they could also, do even better. Now, what's the margin question? This is really tricky, especially given the fact that the business is so massively unprofitable right now, and they're effectively negative gross margin. Their costs are higher than their subscription costs. But advertising revenue can be very lucrative. Advertising revenue, like the margin on that could be like 80%, could be 90%. On each dollar. And then they're wagering, if they're able to get revenue from that long term in terms of optimized margins, that also could be super duper high because you're getting a cut of whatever action is going on. So I think longer term, if you take a long-term approach to this, like 10 to 20% might be a conservative look at what their margins could be in the years ahead. And then the question is like, what's their growth rate? Currently they're penciling out, 70% next year. They're clearly tapping into huge markets. So I'm penciling out 25 to 45% growth. This is annualized over the next 5 years. And so based on these margins, this tax rate, that gets you to net earnings, theoretical, like if this business was optimized for profitability, of let's say 90 million to 400 million, slap on a multiple of let's say 25 to 35 times, and you get downside of, let's say, 40% and upside of nearly 300%. So, while the stocks rallied a lot, I can understand why investors are bidding this up. Like they're looking at something that strikes me as a really interesting growth opportunity that's tapping into some really big markets. And also, like, just high level, they are playing a really interesting strategy. It's like you sell this premium content at cost, maybe even sell it at a slight markup. And you do that to acquire as many customers as you can. You get scale as much as possible. You crush all those incumbent players, all those people that are using a cable TV subscription or satellite TV subscription. And then because you get this scale, you start making money on ad revenue and sports wagering in the years ahead, which could be really lucrative. So, like, when you're looking at the financials over the next few years, don't expect big profit margins. But if you want to take a long-term perspective, and that's how you need to think about stocks, you need to take a long-term perspective whenever you look at any business, they could have really attractive margins, like potentially even more than this 20%. Depends on how you want to think about it. The question is, will they have enough cash to get there without significantly diluting shareholders? They're at a cash burn of $200 million a year at least right now, and they just raised $200 million. So you're looking at effectively 1 year of cash on their balance sheet. How much can shareholders get diluted in the years ahead? All sorts of other questions to ask yourself if you're looking to become a shareholder. But if you want to follow my journey, here it is. I'm highlighting what I think the risk reward is. But if you want to follow my personal journey to see what I'm doing from an investment perspective, I think you know the answer, which is that you're going to need to go to unrivaledinvesting.com, click on Journey, and ultimately my value proposition to Journey subscribers is a few things. First, I'm trying to find potential multi-baggers each month, and one could argue FuBo is a potential multi-bagger. Look, I'm penciling out nearly 300% upside. Second is an educational series to help improve your journey, where it's helping you think about companies better. We're once a month posting a new idea, whether or not it's about, how do you think about finding potential multi-baggers, to another is, how do you think about portfolio allocation? And then lastly, I would say another core aspect of my value proposition is sharing what I'm doing on my investment journey, what I buy, what I sell, what I hold. Each month I give a monthly update on what I'm buying and selling, what's my portfolio look like. And the reality is, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these multi-baggers, go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video learning about FuboTV, please subscribe if you're already a subscriber. I appreciate the love, the thumbs up, and thank you so much for watching.